Hi everyone, welcome to this channel. I am Michelle. Thank you for joining me here. Before I begin, please feel free to subscribe to this channel and on the notification button so that you will receive the latest e-learning videos from this channel moving forward. Today, we're tackling a critical topic that keeps leadership awake at night: fraud. But we're not just looking at fraud detection. We're going deep into how to audit the very framework an organization uses to manage fraud risk. Over the next couple of minutes, we'll move from theory to practice, covering the latest standards, a step-by-step audit framework, and how to uncover hidden risks. Let's start with why this matters more now than ever. The bar has been officially raised. The Institute of Internal Auditors' new 2025 Global Internal Audit Standards are crystal clear. Evaluating fraud risk is not a separate episodic activity. It must be embedded into every single phase of every audit engagement. This means fraud risk considerations must influence your planning, your execution, and your reporting. It's no longer enough to just acknowledge fraud exists. Auditors must now demonstrate with clear evidence how identified fraud risks have directly shaped the engagement objectives and procedures. We are moving from a compliance checkbox to a core competency. To do this effectively, we need a framework. The international standards provide the foundation. They remind us that fraud, in a financial statement context, usually falls into two categories: fraudulent financial reporting, like cooking the books to meet targets, and misappropriation of assets, simply stealing from the company. But to understand why fraud happens, we use the fraud triangle. It gives us three conditions that are usually present: pressure, like a personal financial crisis or an unrealistic management bonus target; opportunity, which is typically a weak internal control or a lack of oversight; and rationalization, where the individual justifies the crime, thinking "I was just borrowing the money" or "everyone does it." Our audit approach needs to test for all three. So our roadmap for today is simple. First, we'll walk through a 5-phase audit framework from planning to reporting. Then we'll look at real-world red flags and, crucially, how to leverage technology and data to find them. Finally, we'll discuss how to wrap it all up in a way that adds genuine value to the organization. Let's get started. Every good audit starts with planning, and for fraud, this means starting with a skeptical mindset. Phase 1 begins even before we look at a single transaction. It starts with the audit team itself. The very first step is the engagement team brainstorming session. This isn't just a casual chat, it's a structured discussion. The team needs to ask, where is the entity vulnerable? How could management override controls? What are the pressures in this industry right now? If the economy is in a recession, but this company is showing record cash growth, the team must challenge that at the outset. This session sets the tone of professional skepticism for the entire engagement. Phase 2 is our formal risk assessment. We need to understand the control environment, the ethical culture set by the board and management. This involves inquiries, but not just with the CFO. We need to talk to a range of people: the chief ethics officer, in-house legal counsel, and even the operational staff who process those complex transactions. We're asking management tough questions. Do you have knowledge of any actual or suspected fraud? What is your process for monitoring fraud risks? But the real insight often comes from asking the others. We want to gauge the culture. We might ask, if an employee saw something unethical, would they feel safe reporting it? The answers tell you more than any policy manual. Now, a great tool for identifying risks here is what's called the fraud exposure rectangle. It expands our view beyond just the financial numbers. The 4 sides of the rectangle are, first, the people, analyzing the integrity and behavior of management and directors. Second, the organization and its industry. How does this company's performance compare to its competitors? Third, its relationships, especially related party transactions that could hide conflicts. And fourth, the financial results themselves. By looking at all four sides, we might spot a discrepancy. For example, if management has a reputation for aggressive targets, the people, and the company is outperforming a declining industry, the organization, but we see unusual year-end journal entries, the financials, we have a clear fraud risk to address. Once we identify these risks, we must document them and, critically, link them to our audit procedures. This traceability is a key demand of the new IIA standards. We need a clear line showing that because we identified X risk, we are going to perform Y test. This transforms our risk assessment from a static document into an actionable audit plan. Now we move into the field. Phase 3 is all about gathering evidence. This is where we respond to the risks we've identified. Our procedures need to be unpredictable. If management knows we always confirm receivables at year end, they can prepare for that. We need to mix it up, maybe visit a warehouse unannounced, or test a control that no one ever looks at. But the core of modern evidence gathering is data. We must leverage technology. We can't just sample randomly anymore. We need to analyze entire populations of data. We're looking for the anomalies, non-standard journal entries posted on a Sunday, round dollar payments just below the approval limit, or a sudden spike in transactions with a new vendor. This data analysis is our first line of defense in fieldwork. A powerful methodology here is triangulation of evidence. This prevents us from relying solely on management's word. Think of it as a triangle with 3 corners. The first corner is management. They provide the financial records and their explanations. The second corner is the information intermediaries. These are the internal support functions like IT, HR, and procurement. If management says sales are up because of a new customer, we can ask procurement to see the contracts or ask IT about the new customer set up in the system. But remember, management controls these functions too, so we need a third corner. The third corner is the external source, the entity's business states. This includes customers, suppliers, and regulators. We confirm the sale directly with the customer. We verify the vendor's existence and license. This triangulation using independent, external sources is what gives us the reasonable assurance we need to form an opinion. A real-world example shows why this matters. Consider a Fortune 50 company that discovered a vendor had created a shell company to claim ownership of songs used in its ads, defrauding them of millions. An investigation revealed critical gaps in their vendor management. How did they find the truth? They used digital forensics. They analyzed emails, text messages, and deleted files. They traced financial records and conducted targeted interviews. This is the level of depth required when fraud is suspected. It shows that auditing fraud risk isn't just about testing controls. Sometimes it's about investigating behavior and following the digital trail. And let's not underestimate the power of a face-to-face interview. While data gives us the what, interviews help us understand the why. When we sit down with a manager, we're not just listening to their words, we're observing their body language, we're noticing the long pause before an answer, the change in tone, or the failure to make eye contact. These non-verbal cues are critical red flags that a simple email or spreadsheet will never reveal. An in-person meeting allows for immediate follow-up questions, drilling down into the inconsistency right then and there. Once the fieldwork is done, we enter phase 4, evaluation and communication. We have to evaluate all the evidence we've gathered. Have we found evidence of fraud? Remember, from a legal perspective, proving fraud requires 5 elements: an unlawful act, misrepresentation, causality, prejudice, and criminal intent. If misrepresentation is missing, it might be simple theft. If intent is missing, it's likely just an error. Our evaluation must consider these distinctions. Our findings, whether conclusive or just suspicions, must be communicated. And the standard is clear. even inconsequential matters should be brought to the appropriate level of management. If we don't, and that small issue turns into a major fraud later, management owns the consequence, but we own the missed opportunity to warn them. Finally, Phase 5, documentation. In the age of the new IIA standards, documentation is non-negotiable. It's not enough to have a risk register that lists fraud as a risk. We need a clean audit trail. Our work papers must clearly show the identified fraud scenarios, the associated controls we plan to test, and the results of those tests. The best practice is to hardwire this into our audit management systems. We should use platforms like Audit Board or Workiva that require specific prompts and sign-offs, making this discipline unavoidable. This ensures that every engagement, no matter how small, has considered fraud and documented that consideration. This isn't just about compliance, it's about building a repeatable, defensible process. And a key part of documentation is coordination. We must incorporate the work of second-line functions, like the compliance officer's AML assessments, into our own audit planning. If the compliance team has flagged a high-risk customer, our audit plan for that business unit must address that risk. This is often called creating an assurance map. It clarifies who owns what in the fight against fraud, preventing gaps and duplication, and ensuring we all work from the same up-to-date information. Throughout this process, we need to be on the lookout for classic red flags. Unusual revenue growth that doesn't match the industry is a big one, so are complex related party transactions that seem to have no clear business purpose. But let's look at a real-world cautionary tale, Barclays Bank. In 2025, Barclays was fined £42 million for failings in its anti-money laundering processes. They onboarded a gold dealer who, it turned out, was receiving hundreds of payments totaling over £46 million from a known criminal enterprise. The red flags were there: round-figure payments of £100,000, a police raid on the client's associate. But Barclays' monitoring was static. They treated KYC as a one-off exercise. They didn't dynamically reassess the risk when the client's behaviour changed. This case is a powerful lesson for us as auditors. It shows that a fraud risk management framework must be dynamic. It's not enough to have controls at onboarding. The audit must assess whether the organisation is continuously monitoring for change. Is it using technology to flag unusual transaction patterns in real time? Does it have automated workflows that escalate a risk score when a red flag appears? Or is it relying on outdated annual reviews that let fraudsters operate for years? As auditors, we must test the agility of the risk management program, not just its existence. So, to wrap up, auditing fraud risk management is no longer a niche specialty. It is a fundamental part of being a trusted assurance partner. We've covered a 5-phase approach, from brainstorming and risk assessment using tools like the fraud triangle and fraud exposure rectangle, through data-driven fieldwork and evidence triangulation, to clear communication and rigorous traceable documentation. The key takeaway is this: move from static compliance to dynamic assurance. Embed fraud into your audit DNA. Leverage technology to see what's hidden. And never underestimate the importance of a healthy, ethical culture. If we do this, we don't just find fraud, we help build organizations that are resilient to it. That's to the end of my sharing today. If you found this channel is useful, please feel free to subscribe and share it out with your friends and colleagues. Thank you and have a nice day. Hi everyone, welcome to this